Welcome back. Banks are more than just places to deposit money or take out loans. In global markets, they provide critical services that keep the financial system running smoothly. These services support everything from international trade to large-scale investments. They help companies manage risks, safeguard assets, and ensure that transactions happen efficiently. For example, imagine a hedge fund needing to borrow shares to execute a complex trading strategy. Or a multinational corporation ensuring its investments are safe across different countries. These activities depend on specialized banking services. In this series, we'll explore key services like prime brokerage, securities services, custodian services, trade finance, and treasury services. These aren't just abstract concepts, they're the backbone of modern finance. Let's dive in and uncover the fascinating world of banking services in global markets. Let's start with prime brokerage, an essential service for hedge funds, institutional investors, and other large market participants. But what exactly does it mean? In simple terms, prime brokerage is a suite of services provided by major investment banks to facilitate the complex needs of institutional investors. These services include everything from trade execution and financing to risk management and reporting. Think about a hedge fund. It often needs access to sophisticated trading tools, margin financing to leverage its positions, and the ability to borrow securities for short selling. This is where prime brokers come in. They provide the infrastructure to make these activities possible. For example, when a hedge fund wants to short sell stocks, it might not own those stocks outright. So, they borrow the stocks from the prime broker, who facilitates the transaction. The prime broker ensures that the hedge fund can access the necessary liquidity to conduct the trade efficiently and securely. Prime brokers also offer other services like portfolio management, trade clearance, and custodial services. They act as intermediaries between hedge funds and the rest of the financial system, ensuring that these complex trades go smoothly. Another important aspect is margin lending. If a hedge fund wants to amplify its returns, it can borrow money from a prime broker to buy additional securities. The prime broker will often require collateral, ensuring that the lender's risks are mitigated. In summary, prime brokerage helps hedge funds and large investors execute high-level strategies by providing them with the tools, resources, and financing they need. Without this service, it would be much harder for these institutions to operate in the competitive world of global markets. Now, let's dive into securities services, a crucial part of global financial markets. This service is primarily offered by large banks to institutional investors like asset managers, pension funds, and insurance companies. But what exactly do these services entail? At its core, securities services help investors manage the securities they own, from the moment they purchase them to when they decide to sell. Think of it like a comprehensive support system for everything related to holding and trading securities. For example, let's say an investment firm buys a large number of stocks. Securities services ensure that the stocks are properly settled, meaning the ownership is transferred securely, and the right amount of money is exchanged. This process includes trade confirmation, clearing, and settlement, ensuring that the trade happens smoothly. But there's more. Securities services also involve custodianship. Custodians are responsible for safeguarding the assets, ensuring they are not lost or stolen. They also handle the collection of dividends, interest payments, and corporate actions like stock splits or mergers. Another key part is fund administration. This includes calculating the net asset value, NAV, of a fund, which is important for determining the fund's performance and pricing. Securities services ensure that the entire process of managing and reporting on securities is done accurately and in compliance with regulations. Lastly, securities lending is another feature, where investors can lend their securities to other institutions, often for the purpose of short selling. In return, they receive a fee. In short, securities services ensure that institutional investors' securities are well managed, properly settled, and secure, helping them navigate the complexities of global markets with confidence. Next, let's talk about custody services, an essential service for institutional investors and large financial institutions. But what exactly does custody mean in the context of financial markets? Custody services are designed to safeguard the assets of investors, ensuring that securities, such as stocks, bonds, and other financial instruments, are securely held and protected. In simple terms, custodians are like the vaults where these assets are stored. For example, if a pension fund holds a large portfolio of stocks, custody services ensure that these assets are protected from theft, loss, or any unauthorized access. Custodians hold these assets in trust and are responsible for making sure everything is accounted for. In addition to safekeeping, custody services also include services like trade settlement, tax reporting, and corporate actions management. If a company in which an investor holds shares declares dividends or has a merger, custodians will manage those transactions, ensuring everything is processed properly. One important role of custodians is to ensure compliance with regulatory requirements. In global markets, there are many complex rules about how assets should be managed, and custodians ensure that all regulations are followed. Custody services also help streamline the reporting process for investors. By providing regular statements on the holdings and performance of securities, custodians make it easier for asset managers, pension funds, and other investors to monitor their portfolios. In essence, custody services offer peace of mind, ensuring that institutional investors' assets are safe, secure, and properly managed. Trade finance plays a pivotal role in enabling international trade, ensuring that buyers and sellers across borders can transact securely and efficiently. Let's break it down. Imagine a company in Brazil importing machinery from Germany. Both parties face risks. The buyer worries about receiving the goods, while the seller wants assurance they'll get paid. That's where trade finance comes in. Banks and financial institutions act as intermediaries, offering instruments like letters of credit. A letter of credit guarantees that payment will be made to the seller once specific terms are met, like delivering the goods. For example, the Brazilian company's bank might issue a letter of credit to the German seller, ensuring the payment once the machinery is shipped and verified. Another tool is trade credit insurance, which protects exporters against non-payment by the buyer. Banks also provide financing options, like short-term loans or factoring, where the exporter sells their invoices to the bank to get immediate cash flow. Trade finance doesn't just reduce risks, it also enhances trust and liquidity in global trade. It supports businesses by bridging cash flow gaps and ensuring smooth transactions, even in complex, cross-border deals. From small businesses to multinational corporations, trade finance is the backbone of international commerce. Treasury services are essential for managing a company's finances effectively, ensuring liquidity, optimizing cash flow, and mitigating financial risks. Let's imagine a multinational corporation operating in multiple countries, each with its own currency and banking regulations. Treasury services step in to help centralize and streamline their financial operations. One key service is cash management, which includes managing incoming and outgoing payments, ensuring there's enough cash to cover expenses, and optimizing the use of surplus funds. For example, a company might use cash pooling, where funds from various accounts in different countries are consolidated into one account to improve liquidity and reduce borrowing costs. Another critical service is risk management. Treasury teams use tools like FX hedging to protect against currency fluctuations or interest rate swaps to manage exposure to changing rates. These strategies ensure financial stability even in volatile markets. Banks also offer payment and receivable solutions, like electronic payment platforms and lockbox services, which speed up payment processing and improve cash flow. Finally, liquidity solutions include short-term investment options for surplus cash, ensuring the company earns returns without locking up funds for too long. In today's globalized world, effective treasury services are vital for businesses to navigate complexities, maintain financial stability, and achieve their growth objectives. Clearing and settlement are the behind-the-scenes processes that ensure financial transactions are completed securely and efficiently in global markets. When a trade occurs, say, buying 1,000 shares of a company or exchanging currencies, the deal isn't finished immediately. That's where clearing and settlement come in. Clearing involves verifying the details of the trade, ensuring both parties have the assets or funds they've agreed to exchange. For example, if you're buying shares, the clearing process confirms that you have the money and the seller has the shares. Clearinghouses, like the London Clearing House, LCH, act as intermediaries to reduce counterparty risk, guaranteeing that the trade will settle even if one party defaults. Once cleared, the transaction moves to settlement. This is when the actual exchange takes place, shares are transferred to the buyer, and money is transferred to the seller. For most financial instruments, settlement happens within a specific time frame, often T+2, meaning 2 business days after the trade date. Efficient clearing and settlement processes are critical for maintaining trust and stability in financial markets. Delays or errors could disrupt liquidity and even lead to broader market instability. Banks and financial institutions play a key role in providing clearing and settlement services. They ensure that trades are processed accurately and on time, supporting seamless trading in everything from stocks and bonds to derivatives and foreign exchange. Without clearing and settlement, the gears of global markets simply wouldn't turn.